In today's video, we're going to be discussing the 5 ways that you get paid in real estate investing. And one of the ways that I'm going to be talking about, a lot of seasoned investors don't even know. Welcome to the channel. My name is Preston and this is the Legacy Investing Show. We're going to be discussing all things related to real estate investing, personal finance, and entrepreneurship. We own a portfolio of 50 plus rental units. We do flips, wholesales, lease options. We own an assisted living facility as well. We've been in your shoes and we know how overwhelming getting into investing can be. And that's exactly why we created this channel, to help you achieve financial freedom. We're going to be sharing all the mistakes, the successes, and all the things in between. If you want to achieve financial freedom, make sure that you like this video and that you're subscribed. We're going to be coming out with 2 to 3 new videos every single week. And make sure to follow us on our socials. We're active there daily and we answer questions there as well. Every single topic that we discuss in today's video is vital to understand, so make sure you watch till the end. In fact, a lot of seasoned investors don't even understand all the ways that real estate can pay you. I'll be discussing arguably the most mind-blowing one at the end, so make sure you stay tuned for that. Quick disclaimer, no investments are guaranteed. There's an opportunity for profit or loss, so this isn't personal or professional advice, just remember that. The first way that real estate pays you is through appreciation. Appreciation is defined as the increase in value of your property over time. Let's say you put a $60,000 down payment on a $300,000 property at a 3.5% interest rate for over a 30-year fixed term. Historically, the average appreciation for real estate is 6% over the years. So if you take that $300,000 house that appreciates by 6% over the course of the year, your house is now worth $318,000. Now you might be looking at this and saying, cool, I just made 6% on my money for doing nothing. You did make a nice $18,000 for doing nothing, but it gets even better than that. Remember, you only put $60,000 down on this $300,000 property. So instead of a 6% rate of return, you're getting a 30% rate of return. And the beauty of real estate is that you're not even making the mortgage payments. If you get a good qualified tenant in the property, in trade of a nice place to live, they're the ones that are going to be paying down the mortgage for you. You only have $60,000 skin in the game, while you leverage the other $240,000 to the bank. You can control the entire asset with just 20% of your own money into the deal, or someone else's money. We'll be coming out with how to leverage other people's money in a separate video, so make sure that you're subscribed. The second way that real estate pays you is through cash flow. This is the obvious one and the term that most people understand. Cash flow is defined by your income minus your expenses. Although you're paid in 5 different ways with real estate, cash flow is arguably the most important one. Cash flow alone, in most cases, isn't going to be the factor that makes you rich. Cash flow is what protects you with turns in the market. Real estate is definitely less volatile than the stock market, but that doesn't mean that you should prepare for potential downturns in the market. Now, before you get ahead of yourself and think that rents minus mortgage is your cash flow, let's define all the things that go into expenses. Mortgage, taxes, insurance, maintenance and capex reserves, vacancy reserve, property management, utilities, and trash, etc. Many people make the mistake that they're making more cash flow than they actually are, and this is where they get hurt. There are lots of bad deals out there if you're not careful. You might be thinking you're making great cash flow each month, but in reality, you're upside down. So when you're analyzing deals, make sure that you consider all those expenses before you purchase the property. Let's take the $300,000 property example, and let's say you're bringing in $2,500 in cash flow in rental income each month. After calculating all your expenses, let's say your cash flow each month is $600 per month. 600 times 12 equals $7,200 a year. Divide that by $60,000 and you're getting a 12% rate of return. If you're keeping track at home, that's 30% on your appreciation and 12% on your cash flow. And honestly, we could have just stopped here on just the cash flow alone. A 12% rate of return typically beats the stock market, but we still have 3 more to go. The third one is tax benefits. This is one of the main reasons that people get into real estate. I know people with huge incomes that invest in real estate just for the tax benefits alone. They'll go out and buy properties that don't even cash flow or even lose money each month just for the tax benefits and banking on appreciation. This is important. I strongly discourage investing like this. Tax benefits are also one of the hardest to measure. You have advantages like the 1031 exchange, deductions, and depreciation. Let's talk about a couple of these now. The 1031 exchange is defined as a swap of one investment property for another that allows the capital gains to be deferred. As an example, let's say your $300,000 property rose in value to $400,000. You now have $100,000 in equity that you can use towards another property. Instead of selling it and being taxed on it, you can roll those proceeds into a larger property. Let's say you identify another investment property that's worth $500,000. You put that $100,000 in equity towards that $500,000 as a down payment. You now own a $500,000 property, and the best part is you don't owe Uncle Sam any taxes legally. This is an oversimplified example, and there's a lot of other rules that go into it. We'll have an in-depth video on this topic a little bit later, so make sure that you're subscribed if you want to see that. Another tax benefit is through depreciation. Once you own a property for more than a year, you can start to depreciate the cost of that property property over time. You're able to deduct a property's loss in value over its expected life, and for residential property, it's 27.5 years. And this is what we'll focus on for this example. With that $300,000 property, you can deduct an annual depreciation of $10,909 per year. You can also write off capital expenditures that you make to the property, like HVAC or a new roof, over a period of years. This can only be used on investment properties. Remember, when you go to sell, that depreciation is going to be recaptured, meaning the depreciated amount is going to be regained and then taxed as ordinary income, up to a tax rate of 25%. But that's why the 1031 exchange is so powerful, because you're able to delay those gains indefinitely. The last one is deductions. You can deduct a multitude of expenses related to your investment property. These include property taxes, mortgage interest, property repairs, maintenance, advertising expenses, property insurance, etc. It's important to keep track of these expenses when it comes to filing your taxes. You need to know exactly what you've spent and take full advantage of these tax savings through these deductions. Again, tax benefits are hard to quantify, but let's give it a conservative 6% rate of return on your money. In reality, it's going to be much higher than that. The fourth way that real estate pays you is through principal paydown. Every single month, a portion of the mortgage payment goes towards paying down the principal balance of the loan. When you first start paying down your mortgage balance, a bulk of that goes towards the mortgage interest. But that doesn't mean you don't get any benefits in the first year. In fact, with the example that I just described, in the first year alone, that's $4,600 in principal paydown. And what makes it even better is that the tenant is paying down the mortgage for you. This is another 8% rate of return on your money. The fifth one, and the one that a lot of people don't know about, is inflation hedging or inflation profiting. This is one of the most overlooked profit centers and ones that a lot of seasoned investors don't even know about. The reason why we leverage debt to scale our rental portfolio is because of this. Let's say you have $100 sitting in your checking account that's not accruing any interest. Average rate of inflation is 3%. At the end of the year, your $100 is now only worth $97, reducing your purchasing power by $3. So how does this work on our $300,000 example? You borrow $240,000 from the bank. Over time, due to inflation, that $240,000 that you owe the bank is going to be easier to pay off. With the Fed printing more dollars and stimulating the economy, there are more dollars that are being circulated. So in 20 to 30 years, that debt is going to be diluted. Just like the purchasing power of the dollar is diluted over time. So ultimately, as wages and prices increase over time, it's easier to pay back that debt. And this is assuming that you got a fixed interest rate. Banks ask that you only pay back in nominal dollars and not inflation adjusted dollars. This is about a 3% return back to you. So let's add up what your return will be on your investment for the first year. You have a 30% rate of return on appreciation. You have a 12% rate of return on your cash flow. You have 6% on tax benefits, 8% on principal paydown, and 3% on inflation hedging. Your total rate of return in this example is 59% for the first year. These numbers will vary depending on a bunch of different factors like the actual property you buy, repair costs, the market you choose, etc. This is a pretty common rate of return that we get on our properties for the first year. And this is a big reason why that we prefer real estate as our primary asset class. If you've made it this far in the video, we know that you're serious about taking control of your financial future. We're going to be providing as much free value to you as possible through these videos. So make sure that you're subscribed and click that notification bell and like this video if you want to be financially free, and of course for the almighty algorithm. Thanks for watching. We'll see you next time.